Well, welcome. Thanks for being here for SPAAR's Beyond the Stats podcast today. I'm Jennifer Kovacich, the Communications Director with SPAAR, here with Erica Brodd and Jordan. You have a new last name. I want to say Jordan Potts, but
Jordan Lundberg now.
Jordan Lundberg.
Yes.
Well, congratulations on your recent wedding, and thank you both for being here today. Today we're going to be talking about insurance and it's how it impacts lending. But first, to just give a quick overview of the Twin Cities housing market for the last 12-month period spanning January to December of 2024, pending sales in the Twin Cities area were up 2.1% overall. Market-wide, however, inventory levels were down 3.4%, and I know we've seen that quite a bit. We all know we need more inventory. The property type that gained the most inventory, however, was the condo segment, where it increased 21.8%, so quite a gain. And that equates to 3.2 months supply for condos. As of December 2024, the median sales price for condos was $205,455, which was just up slightly from the same time frame a year ago. And condos is actually what we're going to be focusing on today for the podcast. Most of us are aware of homeowners associations and what they mean. And in short, they're private organizations, as I know you both know because you work in this quite a bit, that manage and govern a residential community, such as a subdivision, a condo complex, or a townhome development. HOAs are responsible for creating and enforcing rules for a community and collecting dues to cover the costs of running that community. Another type of coverage is the HO6, which is specific to condos. This type of homeowner's insurance specifically is designed for condominium owners, and it's also called condo insurance. It covers the interior of your condo unit, which includes the walls, the floors, the ceilings, and personal belongings within the unit, but typically it does not cover the common areas of the condominium complex, which are often covered by the condo association's master policy. And that, from my conversation with you, is where we're seeing a lot of changes. So I'm curious, what is the difference between a condo and a townhome? It's something I've always kind of been curious about, and here are the experts to talk about that.
From an insurance perspective, they're kind of the same thing. We insure them the same. Our main goal is to build the HO6 or condo insurance policy based on what that association master policy covers. So, but I think from a lending perspective, there definitely is a difference.
Yeah, there is. There's a big difference between what would be considered a condominium and what would maybe be considered a townhome or a single-family home. The difference from my perspective as a lender comes into, when we look at a property that may look and seem like a townhome, but could actually be legally zoned as what's called a condominium townhome, we have different guidelines and requirements for. So for condo-specific units, there's different guidelines that we have to abide by that are set by FHA, HUD, Fannie Mae, and Freddie Mac to be able to make sure that we're able to insure that loan on the secondary market. And when I say insure the loan, I mean that from a mortgage perspective and not from a homeowner's insurance perspective. But the biggest difference and the way that you can kind of discern between what could be a condo townhome or a condominium townhome and what would be a true traditional townhome, or in lending we refer to as a PUD townhome, planned unit development, is in the ownership of the property and the land underneath it. So when you look at a property tax statement, you're going to be able to tell the difference between what is a condominium townhome and what is a planned unit development townhome by the ownership of the land underneath the unit or underneath the property. We all know typical townhomes, they look like an apartment building. You have communal hallways, communal pools, things like that. But when it comes to townhomes that look like townhomes but are actually condominiums, you're owning that unit, but you're not owning the land underneath it, and that is subject to the rules and regulations of your association. And so we see a difference from the lending side. There's a big difference, especially when it comes to FHA financing and any type of government-backed financing, because they do have to be approved for FHA financing by HUD if it is a condo. The process of getting approved for FHA financing as a condominium. You have to renew that approval every few years. I'm not actually sure the exact length of time that you're approved, but it does require reapproval and reissuance. And so VA financing, once it's approved for the first time by the VA, that condo association, it's approved forever. Okay. But you can look up if you're got a potential condominium listing or you have a townhome that looks like a townhome, but you're not sure if it's a condo or not, you can look up the association on the HUD website. So if you just Google HUD condo lookup, you can search by zip code, by state, by specific address, or by association name to see if that association is approved by HUD. If you can't find the association on the HUD website, it's possible that it's probably just a planned unit development townhome, traditional townhome. But if you do find it and it's approved, that's great. You can accept FHA financing. If it's approved and expired, you got to figure out how you can get that approval reinstated if you want to accept FHA financing. If it's rejected, you could do some digging and try to figure out maybe the reason for the rejection. Maybe it's just some clerical errors. You can go back to the association and say, hey, here's what we need to update in order to be able to list this townhome as accepting FHA financing. So as a potential listing agent, it's important to know the difference between a condo and a townhome when you're presenting your listing to the public, because you don't want to accept FHA financing on a condo that is not HUD approved, because you won't be able to close.
Right.
Thanks, Jordan. That's good info. I know in talking about condo insurance, you said there's been a lot of changes in recent months. And I'm curious, what is the impact it has on residents and the condo associations in general? And what do realtors need to know working with clients?
Well, I think where all of this started, and people are even seeing it in their home insurance, is in Minnesota, we have very high amounts of hail, and we've paid out a lot of hail claims, especially in 2022 and 2023. There are a lot of roofs replaced, and it was a huge cost to insurance companies. And now you've got an association master policy that may have changed all their roofs and had to make that claim. And then a couple, there's always going to be individual units that may have a water claim or something else. But now it all bubbles up because there's these multiple claims. And so now associations are running into trouble where they can't afford the renewal premiums. Mm-hmm. They are getting non-renewed for their policies and then going out and having to find different insurance policies that now will only offer so much coverage in different areas. And so because of this, it's showing up at the, blending process. It's showing up when it comes to us trying to insure their condo, their own HO6 policies. Mm-hmm. And I think Jordan and I could probably give a couple examples of situations that we've seen come through. I don't know if there's something that you've seen that's hung up a closing or...
Yeah. We've had it increasingly happen this past year, and I'm sure even more going into 2025, just as a result of all the natural disasters that we've had throughout the country. But we've seen a lot of, well, I shouldn't say a lot, but we've seen issues arise in the lending side of the home buying process where a property owner is unaware of the changes in their condo's master policy, and the listing agent maybe is unaware as well of the changes that have occurred within their master policy insurance. And it's not something that typically you go and review first thing right off the bat is the master policy. But it's really important to take a look at them because we've seen a lot of items come up on the back end that have caused issues for listings, for buyers wanting to purchase homes where maybe the coverage in the master policy only covers the actual cash value of the roof on the property. And this came up this summer because this association had recently changed their coverage, and they had never had a sale since they changed their coverage to the actual cash value
So
policy. And so the association, they're a very small association. They're looking to cut costs as much as they can. And so one of the best options for them to do so was to take insurance policy that covered the roof with actual cash value. Lenders and Fannie Mae, Freddie Mac, FHA, HUD, they don't accept policies and they can't approve master insurance policies that have actual cash value replacement coverage for the roof because it's a liability, right? Who knows what the cash value of the roof is currently and how much is the replacement going to cost, and are these homeowners going to be able to afford that? And so actually it was in, I believe, June of 2024 that Fannie Mae made the switch over following the footsteps of FHA and Freddie Mac to not allow ACV coverage on master insurance policies. And so that came up as an issue for us this summer.
Right.
And we didn't end up closing the loan because the association leadership wasn't willing to change the coverage. They couldn't get the votes because it was going to be more expensive for the homeowner.
Wow. So could only a conventional loan go through in that?
No traditional financing was able to be used against the property. We couldn't find an FHA route. The property wasn't in a USDA eligible area. Potentially they could have done VA. Our buyer was not.
And so this is like any listing, anyone trying to sell now
anyone in that association trying to sell was not going to be able to sell it to anybody using traditional financing. We could have maybe had the homeowner had the ability to increase their down payment, gone through a non-traditional financing route, but then it would be called, we call them non-insurable condos, basically, and that means it can't be insured on the secondary mortgage market. So we would have to hold that mortgage in-house because it can't be transferred off to the insuring bodies of Fannie Mae, Freddie Mac.
I mean, that's a huge learning lesson that obviously is new. How can people be prepared? And it sounds like, read through the policies, find out where they stand, but what else can they be doing, or what should they be watching for?
Mm-hmm.
Well, I mean, ultimately, it is getting a copy of that master policy and finding out what it covers. That's the first thing that I do whenever I'm doing any, quote for condo insurance. And the sooner the better. I had a lender reach out to me a week before closing, and they had just found out that their insurance company for the association, American Family, non-renewed the townhome policy, and they couldn't find a new one. So they just added this quick blurb on their disclosure that said, basically the buyer has to get their own policy to cover the entire structure. Wow. So we had to actually write a homeowner's insurance policy for this buyer. And, a condo insurance policy, maybe $600-800 a year. A homeowner's insurance policy, his company he had was like $2,700. It was looking to, and that's a big cost. We did finally find something closer to about $2,000, but all of a sudden you've got that extra amount added into your loan. How a week before closing.
Payment, and a lot of times right now we're seeing buyers on the market kind of, pushing their budget up to be able to get into a home that they feel comfortable in. And so when you have a situation where you've got a borrower whose DTI is not going to allow for a $600 a month insurance policy, we got to really make sure we're looking at those things on the front end. And that's the biggest piece of advice that I could give to real estate agents and other real estate professionals as we go through into 2025 is to be reviewing our master policies, sending them to your insurance agent proactively, but also sending them to your mortgage lender proactively. Because if it is a true condo unit, that's going to have to go through underwriting specifically for the condo. And our underwriters are going to very intricately look at that master policy to make sure that it's going to be approvable on the secondary market. And increasingly so, we've seen issues come up on that.
And, with insurance, what's happening with all these changes in the master policy is this coverage is getting pushed to your own HO6 policy to pick up.
Okay.
A lot of it comes in this loss assessment coverage. You had mentioned earlier that, that condo insurance policy can cover, the interior structure, their personal belongings, also has liability coverage. But now the biggest, almost most important coverage that's coming to light now is the loss assessment coverage. Okay. And so when there is a covered claim on the association policy, and there could be a really high deductible on the association. Let's say there's a $20,000 deductible. That means that if this homeowner or this unit owner has a claim and that association policy isn't even going to start coverage until that $20,000 deductible is met. And so it's a $50,000 claim. Now that deductible is assessed to the unit owner, and that's where loss assessment comes into play. Traditionally, it's always been about $10,000 in loss assessment coverage. The most deductible, highest deductible you'd see is $10,000. Now it's going up $50,000. There's percent deductibles on wind and hail, and that loss assessment coverage is more important than ever. And then there's the hard part where not many insurance companies even offer that high a coverage. If I write 15 different condo insurance policies, maybe 5 of those we can find to get up to that coverage amount. So,
do you think that'll grow with how things are going, or?
Something has to give, but it's also a lot for these insurance companies to take on. So it's always this balance of how long it takes to figure out how to price their policy correctly to be able to offer that increased coverage.
Sure. And I suppose it depends on the size of some of these agencies too, and
the companies, and how quickly they can get any changes through an insurance. And that's why we're seeing, a lot of these rate increases too, because policies aren't properly priced for all these losses and claims we've had in Minnesota. And, so they just kind of put on these, across the board rate increases.
Sure. Well.
Yeah, I had to have Erica explain to me loss assessment coverage like 3 times since we've been here, because it's just so detailed. I still have a hard time understanding it. But.
Yeah, it can cover a lot of things. I mean, the key to it is that it's a covered claim on the master policy. But it could be a liability claim. Say you have a community pool and there's, someone's injured, or maybe a death or something big. The association policy is going to have their own liability insurance. But if the lawsuit, is more than, say, they have $1 million and it's $2 million. Now they assess all that loss out and divide it out among the unit owners. The roof claims, wherever there's any lack of coverage, or whatever's not covered in the policy, it's all getting assessed out.
It's craziness.
Yeah, it's a lot going on.
Absolutely. Well, what else do we want to talk about with this, or?
Yeah, well, there has been some positives, and I talk about this loss assessment coverage. And one of the things that was happening a lot last year, and I know I had a lot of realtors that were running into this on their disclosures, is when this loss assessment coverage is paid. So if you have, say, on, August 1st, you had a hail claim. And on the association. So, roofs are all done, everything's finalized, and then they say, okay, there was this, 5% deductible that's going to get assessed out to all the unit owners. So that's where loss assessment comes in, and now you get a letter saying, okay, here, you're assessed this loss. You owe $10,000, from this hailstorm that happened in August. You get the letter in October. Some insurance companies would pay that loss assessment claim on the date of the loss. Other insurance companies would pay it on the date that letter comes, that assessment. And so it was coming to all these closings where all of a sudden you buy a home, a condo in the middle of this, and they're saying, yeah, we had this hailstorm. Now you as the buyer are going to have to cover this upcoming $10,000, payment that's coming along. Well, then that buyer, if their insurance policy they have in place is date of claim, then they're not going to cover it. So there was all this confusion, who's going to pay what. These buyers were left covering this amount or having to renegotiate it. So it's called the Big I, the Insurance Association in Minnesota, and the Department of Congress got legislation passed to clarify who's going to pay and when. And so if ownership changes, it is now legislation that it's the date of that assessment letter, and that insurance company at that time has to pay it. Yeah. So, it's coming, but it's like all these issues are popping up and we're reacting, and it's kind of a reactive environment. But it's good to see that our legislation is, listening and trying to get some stuff through to help this out.
Yeah, I can only imagine how frustrating and confusing that was.
Yeah, we've had them where one of my colleagues they didn't even disclose that there was upcoming loss assessment. And so now she's in her new condo and all this stuff, and all of a sudden this loss assessment letter comes, and insurance company's like, no, we pay date of claim. So.
Yeah, that's unfortunate.
Yeah.
What are you seeing for insurance renewals and the process of renewing?
It's interesting. There's some companies that have decided they can't handle what's going on in Minnesota. They can't get their pricing changed quick enough. They can't get rate increases approved through the state. So they're non-renewing their policies. So I've had about 3 companies in the past year that just say, we're non-renewing every policy in Minnesota, and then we've got to go find them something new. Some companies are getting rate increases through, so they're able to renew these policies, but you're seeing higher rates.
Yep.
And then up front, they're putting a lot of different underwriting in place to kind of tightening up their underwriting. Some are requiring higher deductibles. You'll see percent deductibles on roofs, wind and hail damage.
Yep.
Those are increasing. We've got one company that's a mandatory 2% wind hail deductible. And you've got a $400,000 home, it's 2% of that. So now you're looking at an $8,000 deductible. They are requiring roof ages to be, less than so many years. It is hard to find coverage on a roof over 15 years, and it's definitely not going to be a full replacement. And that's also probably the biggest thing is they're going to the actual cash value on the roof coverage that you're seeing. That's the first time I heard of it for an actual association policy to do ACV. And it just gets my wheels spinning. It's like, now how's the HO6 policy going to cover this? And because there could be a deductible, so the association has this deductible that's going to be assessed out. And then do they assess out the difference in cost of the full replacement on the roof?
Yeah, or...
And then now you're looking
That's the question the lenders are asking.
Right.
And we don't know. It's so new that it's hard to assess the liability of what an actual cash value coverage policy would be.
Right.
That's why it's hard for lenders to approve
and
financing against that.
You had mentioned too, and you don't think about it. It's like, okay, this unit owner paid attention, has the right coverage in their HO6. But on the lender's perspective, what happens when, all the other unit owners or 3 unit owners don't have it? So you guys look at the
bigger picture. We look at the whole picture because especially in a condo and any sort of an association where there's multiple owners under one roof, we have to rely on all the owners to have proper coverage, which would be coming from the master policy. Yeah. So really making sure if you are in an association leadership position and you're reviewing those policies, it's really important. I always say send it to a lender and have them send it to their condo department because they can help you understand if this coverage is going to be enough for resale financing to sell it. So if your homeowners can't sell their units, they're going to need to know that before they accept a new master insurance policy and approve it.
Right. And I think on an insurance perspective, having us take a look at it early, it took me a while of reading through bylaws and association policies, really fun reading. But there is, it spells out what the association policy is going to cover versus what your specific policy covers. And us as agents, we make sure that we're reading through that, finding out specifically what it covers so that we know how to build that policy properly. And with all these, things they're leaving out, that's putting more responsibility on the homeowner, price is going up. And we know, as like you were saying, the, now that insurance is going up, interest rates were higher, pricing's higher, it's a squeeze on these buyers.
It is,
and
yeah.
the more they know up front and the quicker they know it, I think can be really helpful.
Yeah. And with all that being said, we have a lot more buyers that are open to condominiums or townhomes now because they're not finding what they need in a single family home at a price that they can afford. So we're seeing a lot more people open their search up too.
Yeah, I could see that. Though you're saying,
Yeah.
the average median sale price is $205,000.
Yep.
I mean, I'm seeing first-time home buyers on single-family homes. They're buying like $300,000 homes. It's like, wow, that's a lot.
It's a lot. The payments are, just going up, and it's hard for people to be able to digest the increases in housing costs. But, having a roof over your head, having a safe place to live is always going to be a necessity. So you just got to make sure that you're partnering yourself with people who want to help buyers find homes that they're comfortable in and be a resource. Lenders can help. Insurance agents can help. We can all do it together to make sure we're getting people into homes that are safe and comfortable and well insured.
Yes,
specifically.
Absolutely.
And especially with the changes happening, just to really be on top of it and mindful of what they need to know.
Yes, and each association is so different, and how they organize themselves, how they run, how quickly they can make decisions. And I see it just from the documents that are sent to us, how well it's written out, if they've got the insurance information. Some of them you look at, it's like, oh, plain and simple. This is exactly what I need. And other ones you're digging through, there's changes handwritten on bylaws.
Yep, I've seen that.
So I think, that's, one thing to keep an eye on too is, how well they're managed. And
Yep.
Well, this was really great information and a lot of it.
No, right?
Final thoughts as we kind of wrap it up?
Yeah, I think this is maybe not related to condos or townhomes or HO6 policies, but it's tax season right now. So we're seeing a lot of buyers come in ready to use their tax returns for their purchase. So if you're out there and you're trying to pick up new buyers or work through pre-approving people, make sure to remind your friends and family that their tax return can be used for their down payment. It can be used for closing costs, and it's a really great way to get into homeownership. There's statewide programs where you can get in with as little as $1,000 down. And so somebody could become a homeowner this year that begun the year thinking there was no chance. But we can do it. Use your tax return for your down payment. That's what I'm telling all my friends.
That's smart.
Great advice. So
Yeah, no, I just think, overall, I'm here as a resource for realtors and lenders. I know it's more than ever, insurance has become a hot topic.
Yep.
And so, even if I'm not even working on the policy, I'm, open to you reaching out. I know you've thrown a couple situations at me and, like a puzzle trying to figure out what we can do for you.
That one this summer.
Yeah, right. So, just being an expert in an area and trying to help navigate.
And I never thought I'd find insurance interesting, but in talking to you, I kind of find it fascinating.
When Erica talks about it, it's interesting.
Right. Try to keep it simple, right?
Well, Erica and Jordan, thank you both so much. This is really great information and very informative.
Yeah, thanks for having us.
Yeah,
Thank you.